Hey, what's up, dividend growth investors? Mikey Hu here for Dividend Stocks Rock. I hope you are doing well today. Last week, I offered you 3 undervalued US stocks. So today we're going on the other side of the borders and we're looking at 3 of my favorite companies for 2025 in the Canadian market. Before we go there, we're going to look at what happened with my prediction last year. I like to be transparent for my good moves and also for my bad ones. So as you can see on this graph, I do have Brookfield and National Bank that did incredibly well at up 63 and 37% total return, beating the index, which was quite a feat because up like 22%, it is something to do, right? On the other side, Stella Jones had a pretty good year until their latest quarterly earnings that happened to be at the same time as Trump won the election. Nothing against Trump, but because of the tariffs, because of the uncertainties, and because Stella Jones already said that it's going to be a tougher year in 2025, the stock tumbled. It's not the first time, it's not the last time. If you have SJ in your portfolio, you already know that it's a volatile stock. As for TELUS, I still own my shares. I'm still happy about it, even though the performance is not there. In 2024, their cash flow metrics have greatly improved. So cash flow from operation, free cash flow, and lower capital expenditure. So over the whole year, the company was able to cover its dividend with the free cash flow. Expecting the same thing in 2025, but we'll have to see what's going on here. So now the first stock on my list this year, and full disclaimer, I do have shares of all the 3 companies I'm going to talk about today, is Stantec STN on the US side, STN.TO on the Canadian side. The company is an engineering firm. Well, you can see here it has a pretty solid dividend triangle, especially after 2022. So they grew by acquisition. There is a lot of momentum there, so revenue, earnings per share are increasing, and of course the dividend has been increasing steadily over the past 10 years and even more. What I like about this engineering firm is they cover a lot of ground. They have developed expertise in climate change, in renovating old infrastructure, in building data centers. They are pretty much everywhere. On top of that, they offer an all-in-one package to their clients where they can work on the plan, on the building, on the maintenance, and also on the decommissioning of their structures. So it's a all-inclusive for one company, and the company also is able to grow with a lot of acquisitions, which is great because it also offers a lot of cross-selling opportunities. As you can see on this graph, their top 25 clients are actually dealing with Stantec for more than one need. So it could be about building, infrastructure, energy and resources, environmental services, or water treatment. They have long-term relationship with those, and whenever they acquire a smaller firms, they are able to bundle it up, offering multiple services, increasing the revenue and the earnings. The next one on my list, CCL Industries, a long-term dividend grower showing a steady dividend triangle. Again, the company is growing its revenues, growing its earnings, and of course growing its dividend. Over the past few months, the stock price has dropped a little bit, probably creating an interesting entry point. When it's time to invest during uncertainties like 2025, what I like the most is to have well-diversified companies. So CCL Industries has 4 different business segments and is able to specialize into different niche. One that I really find interesting is the packaging offer in the healthcare business. They have strong customer relationship with all the big guys, including Merck, Novo Nordisk, Pfizer, Johnson & Johnson, Gilead, and others. What is great about them is once they have worked hand in hand with those clients, they have built great expertise in doing their packaging for their products. And it's usually a part that those big guys are not going to shop around every single year. So it creates a sticky business. This segment is about $1 billion in sales year over year, and it's prone to grow even more going forward. On top of being very strong about packaging for food and beverages and also the healthcare services, the company is also diversified into the label and RFID tags. So with Avery, they offer everything you need at your home office or for big companies. I like this business segment that is about $1 billion in sales because it incurs a lot of repetitive purchases. You need those labels, you need those stickers, and you're going to keep on buying those, making predictable cash flow, which is great for a dividend grower. Before I move on to my third pick, I would like you to invite to download the top stocks for 2025. This is a short booklet with 6 different ideas under 3 different sectors where they're based on companies showing a great dividend triangle. So revenue, earnings per share, and dividend increases over the past 5 years at least. And also that shows a great opportunity for 2025. So if you're looking for more ideas and you want to dig into a little bit deeper into an investment analysis and what I like about those, you can download the booklet at dividendstocksrock.com/topstocks. So my last pick for 2025 will not surprise anyone. It is Alimentation Couche-Tard. This one is one of my favorite stock, and they had a pretty bad year in 2024. So revenue struggled, earnings went down, the company's facing customers that are not willing to pay extra prices in the convenience stores. Fuel sales are slowing as well. So they are in a rut. However, it's not the first time, and it's probably not going to be the last time. If you look at the revenue graph, you will see that between 2016 and 2017, we had a period with barely no growth. Between 2020 and 2022, it was pretty much the same thing. And now we're in the middle of like another down cycle where the company will readapt and going forward will find other ways to grow. So while we don't know what's going to happen with 7-Eleven acquisition, between you and me, I don't think it's going to happen, but we never know. At this time, 25% of the company's revenue is coming from Europe, 12% from Canada, and the rest is coming from the United States. It's about 2/3 of the business in terms of profit as well. In terms of product mix, what I find very interesting is only 25% of its revenue comes from merchandise and services, but it accounts for half of their profit. And this is exactly where they're trying to build more momentum. Between 2018 and 2023, they came with a 5-year plan. The goal was to double their earnings, and they actually did even better than this. In 23, they came with another 5-year plan, which is pretty much the continuation of what was made before. The goal here is to offer better products, fresh produce, improve the margin inside the convenience stores, making some acquisitions on top of that. So if it's not 7-Eleven, it's going to be something else, and improving their fuel supply chain to sustain the growth into the fuel cells and get better margin. I don't know if I'm going to be right again, and I'll let you do your due diligence, but the last time I highlighted Couche-Tard, it was in 2021 when they failed to acquire Carrefour. The stock price dropped by 10%, opening the doors to a great opportunity. So while the rest of the market in 2024 was up 20%, ATD pretty much did nothing. So in my opinion, it could be a pretty good entry point at this level. So all right, guys, that's enough for today. Do not forget to like and subscribe to the channel to not miss my next video on next Thursday. I'll see you in the comment about your favorite Canadian stocks for 2025. Looking for some ideas. Let's share the wealth together, and we're going to talk again next week. Until then, don't forget to stay invested.